Hello, I'm John Williams Sr. I served as a member of the Tax Reform Commission for Kentucky. I'm the founder and chairman of CSI in Paducah. The speech that follows was presented to the board of the Kentucky State Chamber in Lexington on January the 11th. Following that presentation, I was asked to record the message for other viewers. My goal today is to provide education on the process of the Reform Commission and the package of 54 recommendations. Our report was presented to the governor on December 17th, and he is meeting with the leadership of the General Assembly and expects to call a special session. I should comment that the first 75 pages of this contain our report, and there's a lot of material in the appendix that the Commission reviewed. The Commission represented a cross-section of philosophical beliefs about tax. Very extreme views were represented by the 16 appointees to the Commission, and then we had 8 ex officio representatives, non-voting representatives from the Senate and the House. We held 15 sessions, including 6 public hearings held from Paducah to Pikeville. We studied current taxes and comparisons to competitive states. Frankly, we asked the consultants to consider beyond just surrounding states, and we compared to 12 other states surrounding, plus primarily the Southeast. We also hired consultants, 2 from the University of Kentucky and 1 from the University of Tennessee. They did the competitive studies. They also made recommendations of improvements to Kentucky's tax program. They made 19 recommendations, and we adopted 15 of their recommendations. We rejected 4. We had input from the Department of Revenue. They made 21 recommendations to fine-tune and improve our statutes, and we recommend 19 of those 21. We had a very active website, and that website is still live. Go to lieutenantgovernor.gov site. Our Lieutenant Governor created a section for the Tax Commission, and on that site is both the reference material that we reviewed and worked with, plus there are full tape recordings of all of the public hearings where you can hear the comments from those across the Commonwealth. We had input on that website from anybody who wanted to put their opinion in on an idea or a problem with our tax system. And finally, we had input from the members of the Commission itself. In total, we considered from all of those sources 98 specific topics. Our objective ended up being to broaden the base of Kentucky's revenue and make proposed modifications to cause the probability of our revenue to increase and grow with the Commonwealth's growth. And that's called, in economic terms, elasticity. Today, our tax revenues are not growing with the economy, and that's been going on for several years, which increases the size of the gap. We ask our consultants to forecast out into the future, and their forecast says that by 2020, we will have another gap of $1 billion unless we adjust the structure of our tax system. That's on top of the fact that in the past 5 years, $1.6 billion has been reduced from the Commonwealth's budget as we have been in a tight economic cycle, and many of our departments have been cut to the bone. Out of the 98 recommendations, we approved and recommend to the General Assembly 54 separate items. We rejected 44. We viewed all items from the viewpoint of simplicity, fairness, competitiveness, and elasticity. Frankly, of the 54 recommendations, 18 of them are recommendations to reduce income to the state because of fairness or competitive issues. We viewed the entire package from an adequacy standpoint and recommended some increases in tax. We found many items to be unfair, either horizontally, like one company compared to another company, or vertically among income strata of our population, or unfair competitively across state borders. Among the 54 recommendations, 11 of them relate to what I call 4 strategic bold moves. The first of those is to restructure the personal income tax system. The second would be at the corporate level to go to a single factor on sales to apportion the net profits of a company that has business in multiple states. The third would be a sales tax on household consumed services and expand the service tax base. And the fourth, to provide more local income options for our local government authorities. The bottom line net of the recommendations of our commission are just under $700 million worth of increased revenue to the Commonwealth of Kentucky. We started by the question of asking the question, how does Kentucky compare? And in this case, to surrounding states. Today, if you take state and local taxes, the average Kentuckian pays 9.3% of their income in state and local taxes combined. How does that compare? In Illinois, it's 10%, Indiana 9.5%, Ohio 9.7%, West Virginia 9.4%, and yes, to the south, Tennessee 7.8%. But against everybody except Tennessee, we're very competitive. Now, from a corporate standpoint, there are several major studies that have been done on how Kentucky is structured competitively, the last one being done by KPMG. And frankly, when you put all of the taxes together, Kentucky is very competitive today with our current structure. That having been said, we still have horizontal inequities, elasticity problems, simplicity problems, and yes, we have a regressive total package, regressive as it relates to income groups. Now, frankly, on the regressive subject, that's true nationally. Delaware is really the only state that's close to not being regressive. And the reason is because states are unlike the federal government. The states are operating at a lower tax level, but have the majority of the income of the state on things that are basically regressive. For example, sales tax, what's called selective sales tax, and we have almost as much of that as we have our regular sales tax on products. Selective sales tax meaning tax on fuel, alcohol, tobacco, and utilities. And then the final one would be property tax. If you add those three together, it represents 60% of the income to the Commonwealth of Kentucky. Those three are all basically inherently regressive. So what we have is people at the lowest level that's rated below $30,000 income pay not 9.3%, but 10.8% of their income. Folks above $350,000 income annually are at 6.1%. So we go from 10.8 down to 6.1, and that's the regressivity in total of our current tax system in Kentucky. Your commission was very sensitive to that issue as we looked at each other issue, and I'll comment more about that in a moment. Let's talk about corporate taxes. Today, we have about $3.5 billion worth of personal income tax. We have $300 million corporate tax in Kentucky. Corporate tax is becoming a thing that will someday be non-existent. And part of the reason is, over the last 15 years, we've had many companies that have converted to pass-through kind of structures, an LLC structure, an S-corp structure, et cetera, where the income is passed through to be paid at the personal tax level as opposed to at a corporate tax level. So today we have only $300 million left in terms of pure corporate income tax. The state staff would love to eliminate it. Well, frankly, we're recommending to eliminate about $138 million of it, and I'll get into some of those details. We looked for things where we need to close loopholes from a fairness standpoint. Let me give you a couple of examples. We have companies in Kentucky today who operate in multiple states that will cherry pick which state they want to transfer income or expense to so that they pay less tax in that state. And that's done through transferring management fees state to state within a corporate structure. Our tax folks estimate about $13 million worth of that is going on, and our recommendation is that we close that loophole and that we require the add back of the management fees to the Kentucky tax base. Another example would be, let's assume you want to print a brochure, and you have that brochure printed, and the house that prints it also has a mailing service, and they apply the postage and mail that brochure for you. Today, you pay that organization, you pay sales tax on the postage in addition to the printing. Now, if you just go to a print shop and get a brochure printed, then take it down the street to a pure mail house, you don't pay the sales tax on the postage. Is that fair? We recommend that error be eliminated. Frankly, that came about because of the streamlined sales tax process that's been underway for about a decade, and that process is all designed to make sales tax more uniform across the entire United States, and this is kind of a fallout from that. Now, the first bold strategic recommendation that we're making relates to how you apportion net profits for a corporation that operates in multiple states. Today, Kentucky has very much of a disincentive for companies to headquarter in Kentucky. Let me give you today we have a four-factor apportionment formula. It's sales twice, plus employees, plus capital. In each case, you compute the percentage to the total business of the company. 18 states have gone to a single factor dealing on sales. To illustrate how this works, and it can get a little complex because of how you define sales in one state versus another, but a simple version might be viewed this way. Let's assume that I'm a company located outside of Kentucky. I have no employees in the state. I have no capital in the state, but 10% of my sales are in Kentucky. So I take 10% plus 10% plus 0 equals 20. Divided by 4 is 5%. I multiply 5% times my net profits. That's my apportionment for Kentucky. And that 5% gets taxed at 6%. Well, wait a minute. I had 10% sales. I'm only taxing 5% of my profits. That effectively gives me a marginal rate of 3%. Now let's look at a company headquartered in Kentucky, and we get the reverse result. Let's say there's 10% sales. That's 10 plus 10. Let's say it's 20% employees and 20% capital. 10 plus 10 is 20, plus 20 on employees is 40, plus 20 is 60, divided by 4 is 15. So I multiply 15% times my net profits, and I pay 6% Kentucky tax on that. Wait a minute, my sales were 10%, but I'm paying tax on 15% of my profits. I have an effective marginal rate of 9% in Kentucky. That's what we're doing to multi-state companies headquartered in Kentucky today. We are frankly favoring the companies that are located outside of the state and don't employ anybody in the state. This has been strongly recommended by our consultants. It was recommended in every public hearing. It was recommended by the Kentucky Society of CPAs, and it will cost us about $110 million for that one item, but it'll make Kentucky far more competitive. Today, that is a very negative corporate competitive item. In addition to the single factor sales, like 18 other states have done, we also recommend redefining how you define sales. And in tax terms, it's called destination sourcing. And destination means where's the buyer located? What's the zip code of the buyer? So that all zip codes within Kentucky, that defines the buyer. It's not based on where a merchandise is shipped from or delivered from. It's where you buy the service or product in Kentucky. Now, frankly, we have the same problem at the county level in Kentucky, but our commission refused to address it simply because we didn't have access to all the data at the county level. That's a separate statute. It's not operated under the Department of Revenue. We have a two-factor apportionment at the county level, and it can be just as negative as our four-factor at the state level. Inventory tax has long been a challenge for many companies in Kentucky. We recommend the removal of the inventory tax at the state level. We can't, at the state level, recommend removal at the local level because the local governments are dependent upon that tax basis. I happen to personally know a number of local governments have eliminated that locally because of it being a negative problem. Another competitive issue occurs in automobile trades. If you go in to trade in a car on a used car, the value of the car you're trading in is subtracted from the value of the car you're buying, and you apply the use tax on the net difference of the values. If you go in to buy a new car, you get zero net value for the car you're trading in. You're paying the use tax on the entire automobile when you buy it. Every state surrounding Kentucky allows the trade-in credit on the value of your car you try to trade in on a new car. Kentucky automobile dealers revealed to us that they sell an average of 24 new cars per thousand per year in Kentucky, whereas new car dealers in surrounding states sell an average of 35 cars per thousand per year. Why are we putting a cap on the ability of our folks to sell on a competitive basis? We also recommend the institution of an R&D tax credit, and in this particular case to include labor. A lot of R&D tax credits only focus on bricks and mortar, but today much of the best R&D is in brainware, in hiring good talent, and we recommend including that. We recommend and encourage a tax credit for angel investing at 40% of the investment in an angel, very high risk investment. The folks in Northern Kentucky and the Chamber and the Economic Development folks have had a bill before our General Assembly for the last 3 sessions that's targeted toward this. We currently have an angel credit available in Kentucky, but it's available to a group, an angel group, and not to the individual investor. It flows through to the individual investor, but unless the group complies with all the hoops necessary under the current program, there is no credit involved. Limited liability structure is a structure that was one of the pass-through structures. And over the last decade, there have been a couple of efforts by the General Assembly to make changes on how you have some tax on this interim structure. Today, the minimum tax for an LLET operation is for $3 million in revenue, and that tax is $175, and there's an offset credit against tax at the personal level that's involved. We recommend lowering that to $1 million, and frankly, whether we're dealing with other states surrounding or the entire nation, the $1 million is still probably a very high amount.